Most traders lose money in the first 3 seconds of a trade, not because they pick the wrong direction, but because they enter before the market confirms it wants to move that way. Jesse Livermore learned this lesson the hardest way possible, by losing fortunes on good ideas that arrive too early. The amateur sees a trend starting and rushes in, convinced timing is everything. The professional sees a trend starting and waits for proof. This distinction, between belief and confirmation, separates the broke from the wealthy. Today you're learning Livermore's two-bar reversal trick, a setup so simple that most traders reject it, yet so powerful that it's defined profitable trading for over a century. This isn't a magic pattern. It's a rule about patience masquerading as a pattern. By the end of this video, you'll understand why the market doesn't reward speed. It rewards discipline. And you'll see exactly how Livermore used this one setup to turn thousands into millions. But first, you need to understand what you've been doing wrong every single day you trade. Think about your last 10 trades. How many of them felt right in the moment, but turned against you within minutes? How many times did you watch price move in your direction hours later, after you'd been stopped out? The pattern is so consistent that most traders blame bad luck or poor timing. The truth is darker and more actionable. You entered before the market confirmed the direction. You trusted your analysis, instead of trusting the tape. Livermore's entire philosophy pivoted on this single realization. In his early years, he was brilliant at reading charts and predicting movement. He lost millions anyway. Why? Because prediction and confirmation are not the same thing. A prediction is what you think will happen. Confirmation is what the market is actually telling you has already begun to happen. The amateur conflates these two. He sees support holding and predicts a bounce. He enters before the bounce arrives. The market finds new support lower, and he's trapped. The professional sees support holding. He waits. If price bounces first bar of reversal energy, he still waits. Only when the second bar confirms the bounce, only when price closes above the first bar's opening level, does he enter. By then, 70% of the move is over, but he's right, and he's calm, and he sleeps well. This is the psychological chasm that separates lifelong winners from serial losers in trading. It's not about being smart, it's about the discipline to wait for confirmation before committing capital. Livermore spent his early years trying to outsmart the market. He read every book, studied every pattern, and lost money in every way imaginable. He was broke by age 23. He had thousands, then nothing. Then thousands again, then nothing again. The cycle repeated until he made a decision that changed his entire life. He stopped trying to predict. He started waiting for confirmation. He called this shift reading the tape. The tape, in his era, was the literal ticker showing live price and volume. Today, the tape is your candlestick chart updated in real time. The principle hasn't changed. Price tells you the truth. Your job isn't to guess what price will do next. Your job is to wait until price shows you what it's doing right now. This distinction sounds subtle, but it's the difference between a career and a gambling addiction dressed up as trading. When you enter before confirmation, you're betting. When you enter after confirmation, you're trading. The two-bar reversal rule is the simplest possible way to formalize this shift. It gives you a mechanical, emotionless criteria for entry. No guessing. No, I think it looks like a reversal. Either the second bar closes in the opposite direction of the first, or it doesn't. If it does, you have a setup. If it doesn't, you wait. The beauty of this rule is that it forces you to be right twice before you risk anything. The first bar moves one way. That's not enough. The second bar must confirm it moved the wrong way. Only then do you have permission to trade. This is how Livermore turned $1,000 into $3 million in a market environment that was far less liquid and far more manipulated than today's markets. It wasn't speed, it wasn't genius, it was the discipline to wait for the market to confirm direction before committing capital. And it's the same rule that will work for you, if you're willing to accept that patience is not laziness. Patience is the highest form of active trading. By the end of this video, you'll have a complete system for identifying these two-bar reversals, sizing your position so losses don't touch your psychology, placing your stop at the exact level where the pattern breaks down, and waiting for the setup to repeat across multiple time frames before deploying full conviction. You'll understand the psychology that makes this work. You'll see the mistakes that broke Livermore in his early years, the mistakes that broke millions of traders since, and the exact mistakes you're probably making right now. And most importantly, you'll have a framework for entering trades that feel boring because they're low risk, but that compound into wealth because they're high probability. The market doesn't reward speed. It never has. The traders who got rich fast also got poor fast. The traders who got rich slow are still rich. Livermore lived to prove this truth. He died broke, yes, but not because his methods failed. He died broke because he abandoned his methods in his final years, chasing action instead of confirmation. He forgot the core lesson that made him wealthy. The real money is made by city, by waiting, by letting the market confirm its move before you commit. This is what separates professionals from amateurs. Not intelligence, not luck, not a secret pattern, just the discipline to wait for the second bar. Here's what happens in a reversal. The first bar is a fake out. Price moves aggressively in one direction, trapping late money in amateur positions. Volume floods in, emotions spike, and everyone thinks they know where this is going. Then, the second bar closes in the opposite direction. That's when professionals recognize the setup. Livermore called this the tape telling the truth. He watched the tape, the live price action, and waited for the second confirmation. One bar moving against trend is noise. 2 bars moving against trend is a signal. A trader named Paul watched the market spike down on a bad earnings report. He saw the bounce first bar and shorted immediately. Classic amateur mistake. The market reversed on the second bar, and he was underwater 2%. Another trader, Janet, watched the same setup but did nothing on the first bar. On the second bar, when price closed higher than the first bar's open, she shorted aggressively. She caught the full reversal, banking 8% in 2 days. The difference? Janet waited for confirmation. She didn't trade the idea. She traded what the market was actually doing. This is Livermore's core wisdom. The market speaks twice. Listen to both bars, not just the first. Understanding why 2 bars matter requires you to see the market as a conversation between buyers and sellers, not as a predictable line that obeys your analysis. On the first bar, one side, let's say the sellers, takes control. Price drops hard. Volume explodes. Everyone watching the screen feels the conviction. The selling looks relentless. It looks like the start of a crash. So the amateur trader enters short, betting on the continuation. He's run. The first bar is a fake out because the sellers exhausted themselves creating that move. They threw all their ammunition at once, and now they're tired. The buyers, who stayed quiet during that first bar, step in on the second bar. Price bounces. The sellers panic. They buy back their shorts to cut losses. This buying pressure continues into the close, and the second bar closes higher than the first bar opened. Now the market has spoken twice. First it said we're going down. Then it said actually we're going up. That contradiction is the signal. Amateurs see the first bar and make a decision. Professionals see the first bar and wait for the second bar to confirm or deny it. This is not hesitation. This is discipline. Livermore tested this principle thousands of times on the tape. He would watch a price spike, note the reaction, and ask himself, did this move have conviction, or was it a trap? The first bar alone never told him. But the second bar always did. If sellers made the first bar down aggressively, and buyers made the second bar up aggressively, the tape was telling him the buyers had won control. That's when he acted. The mechanics are simple, but the psychology is where most traders fail. When you see the first bar, the aggressive move, your brain floods with adrenaline. You feel the momentum. You fear missing the move. You enter. 90% of traders enter on the first bar. 10% wait for the second. Guess which group makes money? The problem is that the first bar creates a false sense of certainty. Price moved hard. Volume was high. The direction seemed obvious. But certainty and confirmation are different things. You can be certain that price moved down. That's a fact. But you're not certain that price will continue down. That's a prediction. The second bar turns prediction into confirmation. When the second bar closes opposite the first, it's telling you that the initial move lost momentum and reversed. That's not a prediction anymore. That's a fact written in price action. Paul's mistake was entering on the first bar, before the market confirmed the direction. He saw the spike down and thought, this is it, the crash is starting, I need to short now. He didn't wait for the second bar. The second bar arrived, price bounced, and he was wrong. He lost 2%. Janet's wisdom was waiting. She watched the same first bar. She saw it but did nothing. She told herself, I'll see what the second bar says. The second bar said the market had reversed. She entered short with full conviction, because the market had now spoken twice. both times confirming weakness at the higher levels. She made 8% in 2 days because she was fighting with the trend, not against it. The tape had confirmed the new direction, and she rode it. This 6% difference between Paul and Janet is not luck. It's the difference between entering before confirmation and entering after confirmation. Scale this across a year of trades, and Paul is down 20%, stuck in the grind of losses and forced decisions. Janet is up 40%, compounding quietly, with fewer trades and higher conviction per trade. Livermore's insight was that the market doesn't lie, but it does fake you out on the first bar. The first bar is the market's way of testing whether the old trend still has support. If price moves hard in one direction on the first bar, it's testing that direction. If the second bar reverses, the test failed. The old direction lost support. A new direction is beginning. This is why 1 bar is noise and 2 bars is a signal. 1 bar could be anything, a spike, a panic, a false breakout, a stop run. But 1 bar followed by a reversal on the second bar is pattern, it's structure, it's the market telling you something has changed. Livermore would spend hours watching the tape, waiting for this exact structure. He called it reading the tape because the tape, the price action, never lies. But you have to read it twice. You have to let the market confirm its story across 2 bars before you believe it. This is the foundation of his entire approach to trading. Not prediction, not genius pattern recognition, just the discipline to let price confirm direction across 2 candles before committing capital. Every single day, amateurs ignore this rule. They see a spike and enter. They get trapped. They blame the market, the broker, bad luck. They never blame themselves for entering before confirmation. But the professionals know better. They wait. They let the market speak twice. They enter only when the tape has told the same story on both bars. Janet knew this. Paul didn't. And the market rewarded the one who understood that patience is not weakness, patience is power. The 2-bar reversal is not complicated. It's just the market confirming a reversal across 2 consecutive bars. But this simplicity is exactly why it works. Complexity fools traders into thinking they've found something special. Simplicity, waiting for 2 bars instead of 1, compounds into wealth over years because it's based on the only truth that matters: the tape never lies, if you wait long enough to read it twice. Here's where most traders fail the 2-bar reversal. They nail the setup but blow up their account anyway. They see the 2 bars, they enter the trade, and they use the wrong position size. Livermore's rule was brutal. Size your position so small that a loss doesn't touch your psychology. If a trade can make you feel anything other than calm, your position is too big. This sounds abstract, but it's mathematical. Let's say you have a $10,000 account. A typical 2-bar reversal setup might have a 3 to 4 stop loss. An amateur puts $2,000 into the trade, 20% of their account. If they lose $80, but they feel it, they panic, they overtrade to make it back, they blow up. A professional puts $500 into the same trade. If they lose $20. It stings for 1 second, then it's forgotten. They stay calm, they wait for the next setup, they compound slowly. Livermore said, "There is the plain fool, who does the wrong thing at all times everywhere else, and there is the Wall Street fool, who thinks he must trade all the time. The zero-doubt margin is the position size at which you can lose without doubt creeping in. It's different for everyone, but it's smaller than you think. The rule, if you're thinking about the loss more than the setup, you're over-leveraged. This is why Livermore never blew up. He wasn't smarter. He just never risked more than his psychology could handle. And the 2-bar reversal, at the right size, becomes a machine. Position size is the invisible architecture of trading success, yet it's the most ignored variable in the entire industry. Traders obsess over chart patterns, indicators, time frames, and entry signals. They ignore the one thing that actually determines whether they survive: how much they risk per trade. Livermore learned this through pain. In his early years, he would nail setups perfectly but use massive position sizes. He'd be right on direction, right on timing, but wrong on risk management. A 2% move against him on a massive position would wipe out weeks of gains. He'd panic, add to the losing position trying to average down, and blow up his account entirely. This happened multiple times. Each time he rebuilt from scratch. Each time he learned that being right on the setup meant nothing if your position size was wrong. The psychological dimension is what most traders completely miss. When you risk too much, your brain enters survival mode. You stop thinking clearly. You stop following. Your rules. You stop waiting for setups. Instead, you chase losses, revenge trade, and double down on bad positions. This is the death spiral. The amateur trader with a $10,000 account who risks $2,000 per trade isn't just risking 20% of capital. He's risking his ability to think rationally. When that trade loses, he's down $160, assuming a 2% loss on the $2,000 position, or $40 lost. Wait, let's recalculate. If he loses 2% to 4% of his position. On a $2,000 position, a 3% loss is $60. But emotionally, he feels like he just lost $2,000. He feels like the entire $2,000 is at risk, even though his stop is only 3% below entry. This emotional magnification is the killer. His brain can't separate the position size from the risk. He just knows he has $2,000 in the trade, and he's watching it bleed. The professional trader, with the same $10,000 account, who risks $500 per trade, experiences something completely different. A 3% loss on the $500 position is $15. He loses $15. His account goes from $10,000 to $9,985. It's barely visible. His brain doesn't enter survival mode. He doesn't feel the need to chase or revenge trade. He simply notes the loss, reviews the setup to see what went wrong, and waits for the next opportunity. This calm is not a luxury. It's a requirement. It's the only state of mind in which you can execute your plan. The zero-doubt margin concept crystallizes this. It's the position size at which you can lose the maximum amount you're willing to lose per trade and still feel completely calm. For some traders, that position size gets them risking $10 per trade. For others, it's $100. For a professional managing a $100,000 account, it might be $500 or $1,000. The number doesn't matter. What matters is that you find the position size at which a loss doesn't trigger emotion. Livermore discovered his own zero-doubt margin the hard way, by repeatedly OV, or shooting it and blowing up. By the time he was 30 years old, he had learned that his zero-doubt margin was much smaller than his ego wanted to admit. He could have been risking $10,000 per trade on a $100,000 account. The math works, if you're right, but he knew that math doesn't matter if emotion overrides discipline. So he sized down to the point where losses literally didn't bother him. A loss was just data. It was the market telling him the setup didn't work this time. It wasn't a personal failure. It wasn't a threat to his survival. It was just noise in the signal. This psychological state is where the two-bar reversal becomes a machine. When you're at your zero-doubt margin, each setup has infinite opportunity cost. There will be another setup tomorrow. There will be another setup next week. You don't need to force this one. You don't need to risk more than you're comfortable with just to make it count. The setup either works or it doesn't. You either hit your target or you hit your stop. And because you sized correctly, both outcomes feel the same, like progress, not like threat. Livermore's aphorism about the Wall Street fool captures the behavioral mistake perfectly. The fool thinks he must trade all the time. He's afraid of missing moves. He's afraid of sitting on cash. He's afraid of being out of the market. So he trades too much. And because he trades too much, he over-leverages to make it worth it. And because he over-leverages, losses trigger panic. And because losses trigger panic, he makes worse decisions. The cycle spirals into account destruction. The professional sees this cycle clearly and refuses to participate. He trades when the setup appears. He waits when it doesn't. He sizes small enough that waiting is painless. And he compounds slowly because he never has to recover from a catastrophic loss. Consider the math over a year. The amateur trader with a $10,000 account might win 55% of his trades. That's above average. But he's over-leveraged, so his average loss is 4% and his average win is 3%. Over 100 trades, he wins 55 trades, $1,650 in gains, and loses 45 trades, $1,800 in losses. He ends the year down $150. The professional with the same account wins 55% of his trades. He's properly sized, so his average loss is 0.5% and his average win is 1.5%. Over 100 trades, He wins 55 trades, $825 in gains, and loses 45 trades, $225 in losses. He ends the year up $600, same win rate. Completely different outcome, all because of position sizing. Livermore never blew up because he understood this truth deeply. He wasn't trying to get rich quick. He was trying to stay in the game long enough to get rich slowly. And the only way to stay in the game is to size your position so that losses don't touch your psychology. A 2-bar reversal setup is beautiful, but it only works if you execute it at the right position size. You can have the perfect entry, perfect stops, perfect targets. But if you're over-leveraged, you'll panic on the first loss and abandon the entire system. You'll miss the next 10 winning trades trying to recover from the one losing trade that shouldn't have hurt you in the first place. Size small. Let losses mean nothing. Let wins compound. That's not boring. That's the difference between broke and wealthy. Now that you understand position size, where do you put your stop? This is where amateurs and professionals completely diverge. An amateur sees a 2-bar reversal and puts their stop just below the low. This seems logical. The pattern breaks if price goes lower. But this is gambling with a random margin. Livermore's method was different. He identified the pivotal point, the price level where the reversal setup loses its confirmation. For a 2-bar reversal, the pivotal point is the low of the S. Ecken bar. If price closes below that low, the reversal has failed. That's where your stop goes. Not at a round number, not at just below, at the exact pivotal point where the pattern collapses. A trader named Marcus watched a stock spike down on negative news, bar 1, then bounce, bar 2. He shorted but put his stop just below the low without calculating. He got stopped out with a 5% loss. A week later, the stock fell 40%. He had the direction right, but the stop was placed randomly. Jenny watched the same setup, measured the exact low of the second bar, and placed her stop just below it, a 2% stop. She was stopped out once, the stop was hit, but over 15 trades, her average loss was 2.1%, while her average win was 7.8%. The difference? She used a rule, not a guess. The pivotal point is that rule. It transforms the 2-bar reversal from a hope into a system. Stop-loss placement is where most traders' systems fall apart. They have a solid entry method. They understand position sizing. But they place their stops randomly, based on intuition or round numbers or just below support. This randomness destroys their edge. The most brilliant entry signal in the world becomes worthless if your stop is placed at the wrong level because you're not actually testing the setup. You're just hoping price doesn't move against you. Livermore's concept of the pivotal point solves this problem entirely. A pivotal point is the exact price level at which the trade thesis becomes invalid. For a 2-bar reversal, the thesis is simple. Price reversed from down to up or up to down across 2 bars. The confirmation of this reversal is that the second bar closed in the opposite direction of the first bar. If price closes below the low of the second bar, what does that tell you? It tells you the reversal failed. The second bar's reversal wasn't real. Price is continuing in the original direct. Your trade is wrong. That's when you exit, not when you feel like it, not when you've lost 5%, not when price hits a round number, exactly when price closes below the low of the second bar. This precision is what separates systems from guessing games. Marcus's mistake was emotional. He saw the second bar bounce and thought, okay, the reversal is happening, I'll short here. Then he asked himself, where should my stop go? He looked at the chart and thought, I'll put it just below the low, maybe a few cents or ticks. He didn't calculate the exact level. He didn't measure. He just eyeballed it. When price dropped back down and tested that low, his stop was hit. He lost 5%. But here's the problem. His stop wasn't placed based on the pivotal point. It was placed based on a vague idea of just below. So when it got hit, he didn't learn anything except that hurts. He didn't understand why his stop was there. He didn't have a rule. Jenny did the opposite. She watched the exact same setup. The first bar dropped hard. The second bar bounced. She measured the exact low of the second bar on her chart. Let's say it was $50.25. She placed her stop at $50.23, just below the pivotal point where the reversal would be invalidated. She calculated her risk. If she entered at $51, the high of the second bar, and her stop was $50.23, Her risk per share was 77 cents. On a $500 position, remember, she sized correctly from the previous chapter. That's roughly 2% of her account. She entered. The trade worked. She made 7.8% over 2 days, but then she ran another 14 similar setups. Her stops were always placed at the exact pivotal point of each reversal. Sometimes she got stopped out early, like on that one trade where her stop was hit at $50.23. But because she was using a rule, she understood that stop wasn't a failure. It was the market telling her the reversal didn't hold. He learned from it. She moved on to the next setup. Over 15 trades, her average loss was 2.1%. Her average win was 7.8%. The math is beautiful. 60% win rate means she won 9 trades and lost 6. She made 9x 7.8%, equal to $70.20 on winners, and lost 6x 2.1%, equal to $12.60 on losers. Net gain, $57.60 on a $500 investment, equal to 11.5% return in a short time period. Marcus's problem wasn't that he lost on that one trade. It was that he had no idea where his stop should be, so he couldn't replicate his system. He couldn't learn from his losses because his losses weren't based on a logical framework. They were based on guesses. The pivotal point transforms stop placement from guesswork into science. Here's why it works. When you place your stop at the pivotal point, you're essentially saying, my trade thesis is that price reversed on the second bar. If price closes below the low of that second bar, my thesis is wrong and I exit. This is logically sound. You're not fighting the market's message. You're not hoping price stays above some round number. You're using the market's own structure against itself. If the reversal was real, price will hold above the low of the second bar. If price closes below it, the reversal was fake and you're out. No emotion, no negotiation. Just a rule. Livermore's entire edge came from identifying these pivotal points across different time frames and setups. He would watch the tape and ask, at what price level does this pattern break? Once he identified that level, his stop went there. Not above it, not below it, exactly there. This precision is why he could trade with confidence. He wasn't guessing. He was testing a hypothesis with a clear invalidation point. The amateur trader doesn't think in pivotal points. He thinks in percentages or round numbers. He says, I'll put my stop 5% below entry, or I'll put my stop at the previous support level. These are generic rules that have nothing to do with the actual setup you're trading. A 2-bar reversal has its own logical structure. Its pivotal point is the low of the second bar, not 5% below entry. Not some random support level. The low of the second bar. That's the only level that matters, because that's the only level that says whether the pattern worked or failed. When you use random stop placements, you accept random results. Sometimes your stop is too tight and gets hit on noise. Sometimes your stop is too loose and you take massive losses. Sometimes you get lucky and price holds exactly where you hoped. This is gambling, not trading. When you use the pivotal point, you get systematic results. Your stop is always placed at the level where the pattern breaks down. Some trades get stopped out because the pattern actually breaks. That's data, that's learning, that's progress. Marcus never understood this. He thought his loss was bad luck. He thought his stop was in the right place because it looked logical. Jenny understood that her stop placement was a rule, not a guess. When her stop got hit, she didn't feel betrayed. She felt informed. The market had spoken. The reversal hadn't held. She moved to the next setup. Over 15 trades, this discipline compounded. The professional trader places stops at pivotal points. The amateur places stops at round numbers or percentages, or just below the low. This single difference, the discipline to identify the exact price level where a setup becomes invalid, determines whether you're trading a system or playing a guessing game. The pivotal point is that level. For the 2-bar reversal, it's the low of the second bar. That's your stop. Not a cent higher, not a cent lower, that exact level. Because at that level, the pattern collapses and your thesis is broken. That's when you exit. That's what separates wins from losses over a lifetime of trading. Gee, that's how Livermore turned thousands into millions while less disciplined traders with better entries still blew up. He placed his stops at pivotal points. He let the market tell him when he was wrong. and he trusted that rule enough to execute it without hesitation. This is the third pillar of the two-bar reversal system. Wait for confirmation, size small. Place stops at the pivotal point. 3 pillars, 3 rules. One system that works. Here's the hardest part. Most traders see one two-bar reversal and think they need to trade it. Livermore's real edge was different. He would see a two-bar reversal and sometimes do nothing. He would wait for it to repeat on a higher time frame or in a different instrument. He called this waiting as a position. You're not inactive, you're watching with intent. When amateurs hear this, they think it's lazy. It's the opposite. It's the highest form of discipline. A trader named Alex saw a two-bar reversal on a daily chart and shorted. He made 3%. He felt good, so he overtraded the next day, forced a trade that didn't fit the setup, and lost 6%. He ended the week down 3%. A trader named Sam saw the same daily reversal and did nothing. He waited for the same setup to appear on a weekly chart 2 days later, a two-bar reversal at a major resistance level. He shorted that with the daily setup as confirmation and made 12% in one trade. He traded once. The amateur traded 5 times. One won big, one lost small. The difference was patience. Livermore's maxim applies here. The real money is made by sitting. You wait for convergence. You wait for the setup to repeat across multiple time frames or markets. You wait for the stage to be perfectly set. Then you act with full conviction. This is where the two-bar reversal becomes a fortune builder, not a pattern chaser's toy. The concept of waiting as a position is so foreign to modern traders that it sounds like heresy. How can you make money by doing nothing? How can inactivity be a strategy? The answer is that waiting as a position isn't inactivity. It's the highest form of active observation. You're watching the market with intention. You're looking for a specific setup. You're studying price action on multiple time frames. You're analyzing where institutional resistance and support actually live. You're doing everything except committing capital, and that restraint is worth more than 100 forced trades. Alex exemplifies the modern trader's disease, action addiction. He saw the daily two-bar reversal and shorted. The setup worked initially. He made 3%. Now his brain is flooded with dopamine. He feels smart. He feels like he's on. So the next day, he's looking for another trade. He doesn't see a clear two-bar reversal, but there's a small pullback that looks like one. He forces it. He shorts. The trade moves against him immediately. He's down 6%. He tries to recover by taking another trade. This one works slightly, but he's still down for the week. By Friday, he's emotionally exhausted, down 3% on the week, and completely demoralized. He's traded 5 times. Only one of those trades fit the actual two-bar reversal setup. The other 4 were forced because his brain craved action. Sam did the opposite. He watched the same daily reversal. He saw it was a valid two-bar setup on the daily time frame. But instead of immediately shorting, he asked himself a crucial question. Is this the best entry for this setup, or should I wait for confirmation on a higher time frame? He decided to wait. He marked the resistance level where the daily reversal had occurred. He told himself, if this same setup appears on the weekly chart at this level, that's when I'll commit. For 2 days, nothing happened. The market drifted. Alex would have forced 5 trades by now. Sam did not. He was waiting as a position. He wasn't lazy. He was active. He was studying the weekly chart. He was tracking support and resistance. He was preparing. On day 3, the weekly chart delivered the confirmation he was waiting for. Price approached the resistance level where the daily reversal had occurred. On the weekly time frame, price formed a two-bar reversal at that exact level. Now Sam had convergence. The daily setup and the weekly setup were aligned. They were telling the same story. He shorted with full conviction. The trade made 12% in 1 week. 1 trade. That's it. Sam traded once. Alex traded 5 times. Sam made 12%. Alex lost 3%. The difference wasn't intelligence. It was discipline. It was the willingness to wait for convergence instead of chasing action. Livermore understood this principle deeply. He called it the composite map. When multiple time frames aligned on the same setup, probability shifted dramatically in your favor. A 2-bar reversal on the daily chart was interesting. A 2-bar reversal on the daily chart that coincided with a 2-bar reversal on the weekly chart at a major resistance level was almost a certainty. He would wait for these moments of perfect alignment. Sometimes he'd watch a setup form on the daily chart and never see it repeat on the weekly. He wouldn't force it. He'd just wait for the next opportunity where the stages aligned. This waiting wasn't wasted time. It was the most productive time because it filtered out 80% of the false signals. The maxim, the real money is made by sitting, isn't about literal inactivity. It's about the discipline to wait for high probability setups instead of trading every setup you see. A beginner trader might take 20 trades per week. A professional might take 2. The professional makes more money because both trades are high conviction setups with multiple time frame alignment. The beginner M aches less because most of his 20 trades are noise. The mathematics are stark. Imagine 2 traders, each starting with $10,000. Trader A, the action-addicted trader like Alex, takes 20 trades per week. He wins 55% of them at an average gain of 1%, but he over-leverages and his average loss is 2%. Over 52 weeks, he takes 1,040 trades, wins 572, loses 468. He gains $5,720 and loses $9,360. He ends the year down $3,640. Trader B, the patient trader like Sam, takes 2 trades per week. He wins 75% of them at an average gain of 3%, and he's properly sized, so his average loss is 1%. Over 52 weeks, he takes 104 trades, wins 78, loses 26. He gains $23,400 and loses $2,600. He ends the year up $20,800. Trader A took 5 times more trades and lost money. Trader B took 5 times fewer trades and made serious money. The difference wasn't luck. It was the discipline to wait for high probability setups instead of settling for anything that resembled the pattern. This is what separates professional traders from hobbyists. Professionals understand that more trades doesn't equal more money. It equals more exposure to noise. It equals more opportunities to be wrong. It equals more emotional stress and forced decisions. The real money is made by sitting and waiting for setups that have multiple confirming elements. The waiting isn't passive. When Livermore waited for a setup to repeat on a higher time frame, he was actively studying the market. He was learning the structure of support and resistance. He was understanding what levels institutions cared about. He was building mental models of how price moved in different conditions. He was preparing himself so that when the setup finally appeared with perfect alignment, he could execute with absolute clarity and conviction. Most traders never experience this state of mind. They're always in a state of mild panic, worried about missing moves, forced to justify their trading activity every single day. The professional trader works in a state of calm patience. He knows another setup will come. He has no fear of sitting in cash. He has no need to justify his inactivity. He simply waits. And when the setup appears with convergence across multiple time frames or multiple instruments or multiple confirming signals, he acts decisively. The 2-bar reversal is a setup, but it's not a reason to trade immediately. It's a reason to start watching. It's a reason to ask, is this the highest probability expression of this pattern? If the answer is yes, if the pattern repeats on a higher time frame, or at a major support, resistance level, or alongside other confirming signals, then you trade with conviction. If the answer is no, if it's just a single daily reversal with no higher time frame confirmation, then you wait, you sit, you watch. You know another setup will come. Livermore made his millions by trading maybe 100 times per year, not 1,000 times, not 100 per month, maybe 100 per year. Each trade was high conviction. Each trade had multiple confirmations. Each trade was a moment where the composite map aligned. This is why he never blew up from forced decisions. He wasn't desperate to trade. He was disciplined enough to wait, and the discipline to wait is the highest form of trading skill because it filters out 80% of the noise and focuses your capital only on setups that have overwhelming probability on their side. When you see a 2-bar reversal on the daily chart, your first question shouldn't be, when do I enter? It should be, is there confirmation on a higher time frame? If no, you wait. If yes, you have something worth trading. This is the difference between fortune and loss. This is why Livermore's maxim, the real money is made by sitting, is the most important principle in all of trading. The setup alone isn't. Enough. Convergence is everything. And convergence only appears if you have the discipline to wait. The 2-bar reversal trick is not magic. It's a rule. Wait for price to move one way, bar 1, Then confirm the reversal with a second bar, bar 2. Size small enough that losses don't trigger emotion. Place your stop at the exact pivotal point, the low of the second bar. Then wait for the setup to repeat across time frames before committing full capital. Livermore didn't become a multimillionaire because he found a magic pattern. He became wealthy because he applied one rule repeatedly with discipline. He cut losses fast. He sized positions small. He waited. He owned his process. Most traders will ignore this advice. They'll see a 2-bar reversal and jump in immediately, convinced this time will be different. They'll use random stop losses. They'll over-leverage. Within a year, they'll be broke, blaming the market. You know better now. You understand that the edge isn't the pattern, it's the patience. If you've absorbed this lesson, the next step is learning how pyramiding rules compound these wins over months and years. That's where the true compounding begins. For now, apply this one setup. Trade it small. Wait for confirmation. Own the process. The market will reward you. Not today, but over time. That's Livermore's guarantee, and it's the only one that matters. Everything you've learned in this video distills down to a simple framework that works across any market, any time frame, any instrument. The framework isn't about finding the perfect pattern. It's about owning a process so thoroughly that you can execute it without hesitation. Livermore spent decades perfecting this framework because he understood something that most traders never grasp. The edge doesn't come from being smarter than the market. It comes from being more disciplined than your own ego. When you see a 2-bar reversal forming, your ego tells you to act immediately. It tells you this is the move, this is the opportunity, you need to commit now or you'll miss it. Your discipline tells you something different. It tells you to wait. It tells you to confirm. It tells you that if this reversal is real, it will repeat on a higher time frame. Your discipline wins over time. Your ego wins today, loses tomorrow. The 5 pillars of Livermore's system are now yours. First, wait for the 2-bar reversal. Not a prediction, not an idea. An actual reversal confirmed across 2 bars, where the second bar closes opposite the first. This isn't complicated. It's just the market telling you twice that direction has changed. Second, size your position at the zero-doubt margin. This is the position size at which you can lose without your psychology entering survival mode. It's smaller than you think. It's different for every trader. But once you find it, you stay there until your account grows large enough to increase it. This sizing rule is why Livermore never blew up. It's why you won't either if you follow it. Third, place your stop at the pivotal point. For the 2-bar reversal, that's the low of the second bar. This isn't random. It's the exact price level at which your trade thesis becomes invalid. If price closes below that level, the reversal has failed. You're out. No negotiation, no hope. Just a rule. Fourth, wait for the setup to repeat across time frames or markets before committing full conviction. A single 2-bar reversal on the daily chart is interesting. A 2-bar reversal on the daily chart that aligns with resistance on the weekly chart is a probability play. A 2-bar reversal on the daily chart at weekly resistance that coincides with a 2-bar reversal on the weekly time frame itself is a near certainty. Convergence is everything. The professionals wait for it. The amateurs aid every pattern they see. Fifth, own the process over time. This isn't about winning every trade. It's about understanding that your job isn't to predict the future. Your job is to execute a rule so consistently that probability works in your favor across 100 trades, 1,000 trades, 10,000 trades. Livermore's entire career proved this principle. He didn't win most of his trades. He won enough of them, sized correctly, and waited for high probability setups. Over time, the mathematics compounded. Now let's close the loops we opened at the beginning. You started this video with a painful question. Why do you lose money in the first 3 seconds of a trade? The answer is that you enter before confirmation. You trade belief instead of reality. You act before the market has spoken twice. The 2-bar reversal solves this by forcing you to wait. You don't enter on bar 1. You wait for bar 2. Only then do you know if direction has actually changed. This single rule eliminates 80% of your false entries. The second loop we opened was the contrast between amateur and professional. The amateur enters on emotion, sizes randomly, places stops at round numbers, and overtrades constantly. He makes 20 trades per week and loses money. The professional enters on confirmation, sizes at the zero-doubt margin, places stops at the pivotal point, and waits for convergence. He makes 2 trades per week and makes serious money. You've now seen exactly which trader you need to become. The third loop was the promise that this system works. Livermore turned $1,000 into $3 million using variations of this exact approach. Not because he was a genius, not because he had insider information, but because he applied one rule repeatedly with discipline. You have the same opportunity. You don't need a secret indicator. You don't need a magic pattern. You just need the discipline to wait for the 2-bar. Reversal, size small, place stops at the pivotal point, and wait for convergence before acting. The loop closes with proof. Alex trades 5 times per week, loses 3%. Sam trades once per week, makes 12%. Jenny uses pivotal points for stops, averages 7.8% wins and 2.1% losses. Marcus guesses at stop placement, takes random losses. The pattern is consistent. Discipline compounds. Action disperses. Your path forward is clear. Start with your current account size. Find your zero-doubt margin, the position size that lets you lose without emotion. Identify a 2-bar reversal on your preferred time frame. Place your stop at the exact low of the 2nd bar. Then ask yourself, is there confirmation on a higher time frame? If no, wait. If yes, enter with full conviction. Execute this 1 time. Then again. Then 50 times. Then 100 times. Over 100 trades, if you follow this framework, you'll have a documented edge. You'll have empirical proof that the system works. You won't need to believe in it. You'll have numbers that prove it. This is the shift from trading on hope to trading on evidence. Most traders never make this shift. They chase systems. They hunt for indicators. They believe the edge is external, waiting to be discovered. It's not. The edge is internal. It's the discipline to apply one simple rule, repeatedly without deviation. The 2-bar reversal is your rule. You've now seen how Livermore used it. You've seen how it fails when position size is wrong. You've seen how it transforms when stops are placed at pivotal points. You've seen how it compounds when you wait for convergence across time frames. Everything you need to know, you know. The only variable left is you. Will you have the discipline to wait for bar 2 before entering? Will you size small enough that losses don't hurt? Will you place stops at pivotal points instead of guesses? Will you wait for convergence inst? Eat of forcing trades? Will you own the process instead of chasing results? These are the questions that separate the wealthy from the broke. Livermore answered yes to all 5. Over decades, those yes answers compounded into fortunes. You can do the same, not overnight, not with 1 trade, but over time if you own the process. The next step is learning how pyramiding rules amplify these wins across months and years. That's where single trade wins turn into account explosions. That's where the real compounding accelerates. But you can't pyramid until you have a solid base. That base is the 2-bar reversal, executed with discipline. Build that base first. Trade it small. Wait for confirmation. Let losses mean nothing. Let wins compound. Then, when you're ready, we'll show you how to turn 2-bar reversals into systematic wealth. For now, you have everything. You have a rule, you have a framework. You have proof that it works. The market will test you. It will show you reversals that fail. It will show you entries that get stopped out. It will test your patience with drawdowns and cold stretches. This is normal. This is the market filtering out traders who don't own their process. You will own yours. And over time, the market will reward you not because you're lucky, but because you're disciplined. That's the only guarantee that matters. That's Livermore's final lesson. Execute it.